Your bank balance might look safe right now, but what if I told you that your money isn't actually sitting in a vault waiting for you? What if I told you that right now, at this very moment, American banks are hiding nearly $400 billion in losses? And here's the kicker, the emergency safety net that saved banks in 2023, it's gone. Stay with me, because in the next 10 minutes, I'm going to show you exactly what's happening behind the scenes at your bank, and more importantly, what you need to do about it today. Look, I get it. Banking feels complicated. It's designed to feel that way. But here's the thing, what I'm about to share with you isn't conspiracy theory stuff. This is straight from federal data, regulatory reports, and what's actually happening right now in 2026. By the end of this video, you'll understand three things. First, why your bank doesn't actually have your money. Second, the exact warning signs that predicted the Silicon Valley Bank collapse, and which banks are showing those same signs today. And third, the specific steps you can take this week to protect yourself. So let's dive in. Here's something that'll blow your mind. When you deposit $1,000 into your checking account, your bank is legally required to keep $0 of it on hand. I'm not kidding. 0% reserve requirements for most accounts. So where does your money actually go? Your bank immediately lends it out. They use it for 30-year mortgages, 10-year business loans, and long-term government bonds. They're betting that you won't ask for all your money back at the same time as everyone else. This is called fractional reserve banking, and it's worked for decades. But here's where the story gets interesting and scary. In 2022, the Federal Reserve did something they hadn't done in 40 years. They slammed interest rates from nearly 0 to over 5% in just 18 months. Fastest rate hike in modern history. Now here's the problem with that. When interest rates go up, the value of old bonds goes down. Think about it like this. If you bought a bond paying 2% interest and now new bonds are paying 5%, your bond just became worthless to anyone wanting to buy it from you. And guess what? Banks across America are holding billions in these old low-interest bonds. According to federal data, U.S. banks are sitting on $400 billion in unrealized losses right now. That's not a typo, $400 billion. Now, some of you might be thinking, okay, but banks are smart. They'll figure it out. Let me tell you what happened to Silicon Valley Bank in March 2023. SVB was the 16th largest bank in America. Solid reputation. Lots of tech startups and businesses banked there. Everything seemed fine until it wasn't. Customers started getting nervous and withdrew deposits. To pay those withdrawals, SVB had to sell their long-term bonds. But remember what I just said? Those bonds had lost massive value because interest rates shot up. So when SVB sold them, they turned paper losses into real losses. This triggered a panic. Within 48 hours, not weeks, not months, 48 hours, customers tried to withdraw $42 billion. The bank collapsed, second largest bank failure in American history. Then Signature Bank failed. Then First Republic. 3 major banks, gone in weeks. And here's what should terrify you. Federal regulators ran stress tests after this happened. They found that 186 banks have the same problem of significant unrealized losses that could sink them if depositors lose confidence. 186 banks. Not tiny community banks. We're talking institutions with hundreds of billions in assets. Now, I know what you're thinking, but wait, isn't my money insured by the FDIC? The FDIC insures your deposits up to $250,000 per bank. That insurance is backed by the Deposit Insurance Fund, which has about $125 billion in it. Except there's $10.5 trillion in total bank deposits in America. The insurance fund covers barely 1% of all deposits. The system only works if we all don't panic at the same time. It's like musical chairs. As long as nobody thinks the music's about to stop, everyone's fine. But what happens when the music actually stops? Here's the other thing nobody tells you. Even with FDIC insurance, when a bank fails, you might not get your money immediately. If the FDIC can sell the failed bank to another bank quickly, you might get access in days. If they can't, they mail you a check. Could take weeks. For someone living paycheck to paycheck, for a small business that needs to make payroll, even a week without access to cash can be devastating. Now here's what's happening right now in 2026 that should have everyone paying attention. Commercial real estate is imploding. Think about it. After COVID, companies realized they don't need massive office buildings anymore. Remote work is here to stay. So office buildings are sitting empty. Property values have tanked. And here's the problem. Banks hold massive amounts of commercial real estate loans on their books. Right now, we're watching $1.5 trillion in commercial loans coming due for refinancing. The scary number. Analysts project that over 50% of commercial mortgage-backed securities maturing this year will default. Why? Because these buildings are worth less than the loans on them. The developer can't refinance at today's higher rates, so they just hand the keys back to the bank. Suddenly, your regional bank isn't just a lender. They're now the owner of an empty office building that nobody wants. So we've got banks sitting on unrealized bond losses, plus a commercial real estate crisis. It's a double whammy. Oh, and remember that bank term funding program I mentioned? The emergency safety net the Fed created in 2023? It ended in March 2024. The training wheels are off. All right, enough doom and gloom. Let's talk about what you can actually do. First, and I can't stress this enough, know your numbers. Check 3 things about your bank. Number 1, the Texas ratio. This measures a bank's credit losses against its capital. Any bank with a Texas ratio above 100%? Red flag. Number 2, Tier 1 capital ratio. This shows how much high-quality capital a bank has. You want this above 10%. Number 3, uninsured deposits ratio. If a huge percentage of a bank's deposits are uninsured, meaning above the FDIC limit, those customers are first to panic and withdraw. These numbers are public. You can find them. I'll drop some links in the description. Second, spread your deposits across multiple banks. Don't keep everything in one place. Stay under that $250,000 FDIC limit at each institution. Third, consider the size and stability of your bank. The big too big to fail banks have more diverse portfolios. Regional banks with heavy commercial real estate exposure? Higher risk. Fourth, look into alternatives. Some people are buying treasury bills directly from the government. Others are using money market funds. Some are even holding physical assets. I'm not telling you to panic. I'm not saying run to your bank tomorrow and withdraw everything. What I am saying is be informed, be strategic, be prepared. Look, the difference between 2008 and now? In 2008, regular people didn't see it coming. This time, the warning signs are everywhere. The data is public. The question is, will you pay attention? Your bank is counting on you not to think about this. They want you to deposit your money, trust the system, and not ask questions. But here's the truth. Being aware doesn't mean being afraid. It means being prepared. And preparation is always better than panic. If this video opened your eyes, do me a favor, smash that like button and subscribe so you don't miss the next one. I've got a whole series coming on protecting your wealth in 2026. Drop a comment and let me know. Are you keeping your money where it is, or are you making changes? I read every single comment. Thanks for watching. Stay smart, stay safe, and I'll see you in the next one.